You don't need to look very hard to find statistics showing that the economy and the stock market are disconnected. Perhaps there are times in history where these two are quite in sync. Right now, however, it's not even close. The economy never recovered in 2008's financial crisis. It's clearly present with this one ever worsening statistic. You came here for the truth, so let me unveil that for you. Today we are going to look primarily at the US. I want to touch on Europe, perhaps even China if we have time. Let me begin by looking at this. On the left-hand side, you can see government financial assistance at record levels. And on the right-hand side, social benefits as a percentage of real disposable income. So let's look at the left-hand side first, whether it is, they're breaking it down basically Medicaid, unemployment insurance, Medicare, Social Security, and so on. You go through this and realize that every year over year, these have been increasing. It's not a new phenomenon. This has been going on for quite some time, obviously. However, when I simply understand the value of our currency, it has been declining. Nobody's going to deny that. And as a result, this purchasing power loss has really cut into a lot of people's income. So when you think about if they're making whatever, $2,000 a month or $4,000 a month, it doesn't really matter when I look at what that can buy. Every year over year, that has decreased. This presents itself with an issue primarily for those who are not making ends meet. Now, if we look statistically, and I've shown you this before, and I'm trying to get to this, is that more and more people today can't make ends meet. It doesn't matter if they're making $100,000 a year. They push themselves to the maximum. They take on the maximum amount of debt, pay what they can on a monthly basis, and find themselves struggling in the end. Looking at this statistic here, it tells me the truth about what's going on. Government financial assistance. People need these programs, whatever it is. They're desperate. They have no disposable income, or at least historically, it's very, very low. I can show you the statistics about people taking on 1, 2, even 3 mortgages. They're taking on all kinds of debt, like line of credits and student loans and credit cards and everything else, maxing it all out with the intention to pay it back. Some of them don't intend on paying it back, but many of them say, I will pay it off next month. I will pay it off next month. And that month never comes. You can see on the right-hand side, comparing that to our disposable income is interesting. These benefits that the average individual receives is becoming more and more of the whole piece of the pie. It's interesting to see the way that this has really unfolded over the years, devaluing currency. At the same time, individuals are forced to, particularly over the last few decades, their so-called inflation statistics don't ever match up with reality. Quite sad to see that. So we have the central banks doing the exact same thing. Their balance sheets are headed in the same direction. Okay, so looking at this, under the current law, federal debt held by the public is projected to increase sharply over the next 30 years. We've got the central banks having their burden on them, having to print more and more, never being able to do their so-called quantitative tightening. And we see that the government itself has its own conundrums. They have decided that they would put the deficits to become forefront part of the issue. This has really never been off the table. Every single presidency that's we've seen here has always been one of spending more The question is, where do we spend the money? That's all. The total value of which continues to increase. There has never been a situation in which we've been better off. It doesn't work like that in terms of the amount of deficits, amount of debt that is being accumulated. There are very, very short periods of time in history where that changes, but it always reverses and people always go further into debt as a result. It's truly sad. So you can see that they're showing us the projections where we will head. It all depends on the markets at the time, of the economy at the time. So these projections are only based on some sort of statistic, but as you can see, there's no such thing as normal historically. All I know is that over these past few years, the amount of debt and deficits have gotten much worse. Okay? As spending grows more quickly than revenues do. Driving that spending growth are interest payments on the debt, major health care programs, and Social Security, putting a heavy burden, not just on the individual, on the government as well. There's a major strain in how much the tax dollars are really able to keep up with the people's needs. That's why they need more and more, but ultimately they're giving less and less. And so we have this underlying issue that people, this is showing us the personal savings rate. It has declined since, back when interest rates obviously were much higher. However, we have seen this savings rate in recent years declining quite a bit. We did see deleveraging that occurred during the financial crisis, but now we can see that clearly more people are spending more money. Now, why would they want to save? This is something I bring up all the time. If they're going to be getting into a bank account, if they're lucky, a normal checking account, this would be something spectacular if you're going to get that 0.5%, perhaps. Maybe you put it into something like some sort of savings account. Maybe you're going to get 1.5%. If you're going to put it onto something that's going to leave you in a situation where you can't take that money out for a little while, one of these so-called guaranteed investments, maybe you're going to get 2 to 3%. Okay. None of these, of course, keeping up with inflation during that period of time. They take your money and they loan it out 10 to 1. They also can take that money, package it up, create derivatives out of it, make tons of profit with that. The games and the schemes are unlimited. But essentially, the average person, they do not have enough savings. They do not have enough income to be able to pay for the ever-increasing prices. Where do the prices come from? From the central banks, of course. I want to switch gears for the next two here, talking about Italy. Their banks bought record government bonds in May. Take a look at this on the right-hand side. Record level. They've never bought this many. Monthly flows of Italian bank holdings of domestic government bonds. They went in, intervened, bought them all up. If the ECB is going to do their quantitative tightening, they may decide to pull out of Italy, even though they're really the only one that was buying previous to the bank buying. And now we have gigantic amounts that are being purchased. Clearly there's a weakness here, and it is not being addressed in the mainstream media, but we need to look at it. All right. Right here. Already, since the US Fed began raising rates and the dollar started rising in response, the effects have been dramatic just in the past quarter, okay? I'll touch on a few of these. All right. The Argentine peso and Brazilian real fell 30% and 14% respectively. Turkish lira, South African rand each fell 14%. A bunch of Asian emerging market currencies 3 to 6%. It goes on. I want to mention this. China's stock indexes fell by double-digit percentages in the quarter, though that might have had more to do with the incipient trade war than the relative inflation and interest rates. Clearly, there's more than one issue at play here. Asian junk bond spreads widened dramatically. Emerging market bank stocks got crushed, some of them down minus 30%. And down 20% in US dollars. Brazil's stock market. It goes on to talk about this. Emerging markets, China, we are looking at places that, obviously talking about it here, Argentina, Brazil, when you look even, obviously Venezuela has been suffering. These currencies are being destroyed. Their purchasing power is being lost, and as a result, the average individual, they're going to the store, they're trying to be able to buy what they need, and it is becoming more and more difficult. The average person isn't getting big raises. It doesn't just work like that. If you're lucky, you get that 3% when it comes time to get your review. 3%, which basically, if you're lucky, doesn't really do much, because the average rate of inflation for most people, depending on where they live, depending on what they buy and so on, is much higher. There are numbers to decide one way or the other, but I just know it's higher than what they're telling us. If you use the old way to calculate it, we are about triple to quadruple the level that they tell us with the Federal Reserve's fake core inflation rate. It just doesn't match up with reality, and it's just silly. Anyway, that's all for this video. A little slower pace. Hope you found it informative. If you did, please give me a thumbs up. Last but not least, if you found this video informative, I know you'll find my books, The Money GPS and Global Economic Collapse, even more informative. You can take a look through these books if you're interested. Links are in the description below. And if you're more interested in the audiobook version, you can get that at themoneygps.com.